starting. All attendees are in listen-only mode.
G'day everybody, welcome to another edition of Ask the Expert, and got something different happening in Perth today. It's actually raining. Haven't seen rain for many months, unlike those in the eastern states. Anyway, let's get on with it. And as you know, I like to start with a bit of a smile, and there's no better place to go than for some political cartoons, and at the moment they just happen to be at the expense of the Labor Party, but that's where most of the action is. So this first one, Julie, if you can't read that, Julie is saying the bad news is we'll have to start cutting back on middle class welfare, but the good news is we're cutting prices on antidepressant drugs. So fairly topical, that one. And here's old Swanee, who's got to try and sell us a really tough budget. So yeah, maybe we'll only get an ice cream out of it. Anyway, a little bit of humour on the side. Just a reminder: this is general advice only, and you certainly need to make all your own decisions when it comes to trading. Now, just before I get started, I'd just like to ask you if you wish to, when we get to questions at the end, if you just give me some indication of things that you would like to see on a regular basis, because there's quite a few of you now that are coming back for more than one occasion, and also welcome to some new faces tonight as well. So I'm really happy to provide as much value as I can, so if you can give me a bit of an indication of the sorts of things that you're interested in. As I've indicated in previous sessions, given that this is a public forum, my hands are tied with respect to commenting on specific stocks because of the financial services laws, but there's plenty of other things that I can certainly talk about. So any indication of the sorts of things that you're after would be much appreciated. So just a bit of a quick global recap for those that aren't necessarily accessing the weekend general global update that I do. To me, the most important markets, and really what determines the direction of the stock market ultimately, is currencies and bonds. They're the big games. That's where the professional players are playing, and they certainly determine what's happening in terms of financial money flows. So it's important to have a look at the bond yields, and they're going to play a significant role in what happens to stocks and especially gold. So let's have a look at first of all at a few charts. In fact, I'll just go through this S&P, and then we'll look at the S&P chart and bond yields together. So the S&P still tracking higher. It's been overbought for many months, as most traders will know, and I believe the indications are, rather than a more meaningful correction that a lot of people have been expecting, it's quite possible that it's going to work off that overbought nature by just going sideways to mildly upwards for a while and just kind of let the market catch up. So that's the way that it's panning out to me. Now, I've still got a nominal target at around 1440. I'm not in the game of predicting, but it's really helpful to have a structure that makes sense according to how crowd behaviour normally pushes the market around, and that's not a bad nominal target at this stage. Now, I've just got a couple of charts here that aren't in Market Analyst, which is the software that I use, and this is the Spanish 10-year bond yields, and you can see back in July and August, when things got a bit nasty, they pushed up above 6%, which is getting towards the unsustainable level when government's got to commit to paying more than 6% for long periods of time. And then we pushed up even higher in November as well. And fortunately, the ECB stepped in and flooded the banks with a lot of money, and that's pushed the yields back down again. But you'll notice just in the last couple of weeks, the Spanish 10-year yields have just pushed up from below 5, peaked out at 5.5. So you know, things aren't quite out of the woods when it comes to Spain. But look, I think the market's probably fairly relaxed about about a real problem in Europe now. I think they perceive that if there is a greater problem, then the ECB is just going to print some more money, and that'll be the end of it. This is the Italian 10-year government bonds. So you can see very similar kind of pattern. It really did spike up above 7% for a period of a few weeks there, and then backed off very, very quickly. It's also ticked up a little bit in the last couple of days, but it's not really impacting the stock market at this stage. Now let's just have a look at a couple of key charts. This is the 30-year Treasury bond yield in the States. So this is the one that influences basically the interest rate on mortgages in the US. So the Federal Reserve really wants to hold this down as low as they can for as long as they can. Their direct influence is on what's called the short end of the curve, which is the 1-year, 2-year and 5-year areas, which is basically more the commercial market. But this yield here, they want to keep this as low as they possibly can, and you'll notice that we had a spike which really started about the middle of March, and unlike the one that we had in October last year, this one has dipped, but on Friday night started to head back up again. Now, there's not enough data to say whether this is the start of a new uptrend or not. So to say that we're now going into a trend higher in yields is just guessing, and it's far too early. But at least the signs are there now. We've been elevated on the yields for longer than we've seen for quite some time. Any other little spikes we've seen have been sharp, and then they've fallen back straight away. This one hasn't, so I think this time there's a greater chance that we're going to get a tick up in long-term yields, and if that's the case, that's going to be very positive for gold, and it's not going to be too shabby for stocks either. Let's just have a look at the S&P. So some of you would have seen this chart before. I believe we're now in a wave that'll take us up, or a series of waves that'll take us up towards 1440. I would expect possibly a bit more of a significant correction when we get to that level, and if that coincided with sometime in May or early June, then from a seasonality point of view, that would be just perfectly spot on as well. So some really key indicators to keep an eye on: bond yields and the S&P, where it is and what it's doing around about May into early June. I think a key signpost to look for. Now the ASX, our poor old index, is like it's stuck in quicksand. Everybody got very excited on Friday when the market shot up a bit, and again this morning when it was up higher on the opening, but it just declined back again, and the futures are, when I prepared this slide about an hour ago, the futures were pointing down, and just before we started this webinar they were still pointing down at this stage. It's really interesting. There's a correlation that I've noticed over many years, and that is that quite often Asian markets will sell off or rise in the same direction as the US ends up doing that night. It's almost like the US is following us. I can assure you that is not the case. I believe what's going on here is that the traders around the world are talking. Traders in Asia have started to get a bit of an idea of how traders in America are going to trade tonight, and our market starts to reflect that, because I've seen the last hour of trading in the Australian market be such a good indicator of what's going to happen in the US. So it's not a perfect correlation, but I would give it an 8 out of 10 that we'll see the US possibly down a bit tonight. Now, consumer confidence has been getting a lot of discussion in Australia, and it's mainly been pretty poor. We got a data point last week that said it was improving, but a company called Metcash, which is MTS, which is one of our retailers, obviously not in the Coles and Woolworths dimension, but certainly up there, and they've gone into a trading halt today, and they're going to be announcing some kind of write-down. So when you've got a company like Metcash announcing a write-down, a supplier of basically staple grocery items, then you know that consumer confidence is not travelling all that well, and you know that the retailing industry is not travelling all that well. They've got lots and lots of headwinds. Now, in the Aussie market, and we'll have a look at these indices in a minute, the banks have been pretty strong. They did get to overbought, so it wasn't surprising to see them pull back a bit today. There were mixed signals on the Chinese Purchasing Managers Index data. The official Chinese numbers said it grew, and one would have to think that there's a bit of hanky-panky goes on with official Chinese figures. But there was a private survey by Hong Kong and Shanghai Bank which said that they actually went down and that manufacturing purchasing was actually in contraction. So yeah, some mixed signals on that one. Small cap energy stocks remain the stars in our market. No question, they're outperforming everything by a big margin. But almost all of these stocks are non-producers at this point in time. They don't have cash flow. Oil and gas drilling is a high-risk business. If this is where you're playing, and that's where the action is, so there's no issue there, but just be mindful of where you're playing. You're playing in the most speculative and potentially dangerous area of the market. If and when sentiment will turn. Now, whether it's next week, next month, next year, I'll know it as it happens when we see it. But just bear in mind, you can lose 10, 20, 30% in the first half hour of trading with some of these stocks when sentiment turns, and at some point it will. So please just bear that in mind. Now, our index started well today, but faded really badly, as I indicated. So have we got a breakout, or have we not got a breakout? I don't really know. There's a bit of importance attached to it if you're trading small cap shares, because, excuse me, pardon me, there is some importance when you're trading small cap shares, because whilst the index only really reflects the top 10 or so largest stocks in Australia, it does have a sentiment effect. And if our index does break out and confirms a breakout to the upside, then that will add further sentiment to the money that's flowing into the small cap sector, because it'll be on the news, it'll be in the papers. People will start to feel better about the stock market, and it'll bring some more speculative money into the small cap area. So it does actually have a bearing. Now the question is, have we actually broken out or not? We've had a couple of goes at it. We've had 9 goes at breaking this 43.50 area, and it got rejected every time. And I've never seen a pattern like that before in my life, where a resistance area has been tested that many times. And we've now had a test on Friday, and it closed on its lows, and another test today, and it's closed on its lows. So I don't know. The jury's still out, in my view. Now let's have a look at the materials index, and I think you can just ignore these volume spikes here. Materials have been struggling a bit lately because of concerns over China. Materials index was doing really well this morning, and then until the market, I think, had a bit of a rethink about the validity of that data. But at least the materials index went up. The banks had got overbought. You can see here the RSI on the, this is the finance index, so the ASX 200 financials, and you can see it had a pretty good run up. It had run from around just under 4,000 points, got to about 4,200 points, got quite overbought, and now we're getting a bit of a pullback. Nothing abnormal about that, and if it just pulls back to these moving averages, or what I call reversion to the mean, then that would be all pretty normal. And let's have a look at energy. And energy really had a great week about 5-6 weeks ago, but really has just been paddling sideways, and that's really, that doesn't reflect the small cap stocks. That's really, you know, Woodside, Santos, and a few of the other larger energy stocks. Now Looking at gold stocks, I just want to take a look at a few, and in doing this I'm not making any comment about the specifics of these stocks, but I want to make a point about some of the patterns there. So we'll have a look at a few gold stocks, and the first one is Newmont. Now Newmont is the world's second biggest gold producer, US company. Let's have a look first of all on a weekly chart. And you can see that clearly the price has been headed down from November. It looked quite buoyant until November, and then in fact it was really leading the way, outperforming Newcrest by a long way. But it's really been pretty significantly down. You can see now though that we are definitely oversold. We're right down on a basically a double bottom or even a triple bottom down here, so it's in the zone where support coming in would make sense. Let's have a look on a daily, and you can see that we had on Thursday night we had a bit of a sell-off and then closed on its highs. Tried to sell off again a little bit on Friday night, but found a bit of support. It's way oversold on the daily chart. So to me, it's just looking like maybe we're at the bottom. Let's have a look at Newcrest, and a similar kind of pattern on Newcrest. You can see on a weekly chart, it's hasn't been as severely down as the American stock, but not looking all that flash. It's well oversold, and also in a position where some sort of bounce from here would make sense. Now let's have a look at RSG. Now RSG is a bit of an interesting one because its price has been affected a bit by what's this coup in Mali and what's going on over there. So that will tend to perhaps disrupt the normal trends a little bit. But it's been quite a strong performer. You can see here it was trading around about $1 in July last year, and we got to $2.20. So it's a reasonably significant gold producer. So anything that more than doubles in price in the space of 6 months, you can say is a pretty strong trend. Now I suspect that's what's happening here is that we're getting a fairly lengthy period of consolidation, so it's consolidating that recent move. Let's have a look at Regis Resources, which has probably been the strongest gold stock trend that we've had in our market, and our gold stocks really have done well. So whilst our index has lagged the S&P significantly, our gold stocks, or a lot of the producers anyway, have beaten the rest of the world hands down. So whilst they haven't necessarily done great things, we're certainly ahead of a lot of other places. So this is Regis. We've recently had a bit of a dip, and it's still looking like a pretty good trend. And the other one that I wanted to cover, it was RMS, but I'll just have a mention of copper as well. And I notice there's a question there on copper. It's continuing to hold a range just under $4, between about $3.80 and $4, which is a very, very profitable area for copper producers, and it's been hanging on to that range now for quite a few months. I'm not sure if I've got a chart queued up on that. Oil remains very strong, and as far as the next few months go, I think with the situation in Israel and Iran, and the current supply situation, I know Saudi's making a few noises about the fact that they've got the capacity to increase output and lower prices, but they never seem to actually get around to doing it. So I would suspect that oil's probably going to remain pretty strong for the next few months. Let me just cover off quickly on RMS. So this is RMS on a weekly chart. You can see there's been a major sell-off from $1.60 down to about 80 cents. Without wishing to go into too much on the specifics, I think this one has been significantly overdone, but nevertheless, it is in downtrend, and you've got to respect that. So I think there's a trade lurking around somewhere on RMS, but I'm not 100% convinced where it is right now. But certainly we've got a real mixture of performance in our various gold stocks. Now, I thought just to try and pick on something that I thought may be of value for you is looking at some things to look out for. And I just got a few charts that I wanted to show you. And these are patterns that tend to catch traders out. The first one is what I call the one-day wonder that comes from absolutely nowhere. And there's a stock called Adelaide Resources. The code is ADN. Let's have a look at this on a daily chart. And you'll notice that through most of this chart, which goes back to July of last year, you'll notice an awful lot of just little ticks on the chart. So in other words, they were days when the price, something traded, but it was so minor that the price didn't really move away from that particular point. And so we trundle along in that mode with very, very little turnover, and then one day we get a significant blip, and that day was the 19th of March, so it's only a couple of weeks ago. And I know reading a lot of material and some of the sentiment on some of the forums, a lot of traders got very excited about this price blip. But it was only one day, there was no follow-through, and as a consequence, we're back down here. So there would have been people that bought in the 10, 11, 12 mark who got really excited that there was a big breakout happening. And now we're now back down under 9 cents. And you know, that's just one of the things that you need with trading breakouts is that you need some consistency and some follow-through. Because a lot of these breakouts do fall over, and particularly getting towards the end of a speculative run. The small caps now have been running very nicely all year. These periods tend to only last for 3, 4, 5 months, maybe 6 months at the most, and towards the end is when you get a lot of these speculative breakouts that fail. So again, just be a little bit careful there. The next kind of stock is the really widely hyped stock, or the market darlings, and there's a couple here to point to. One is PLA that had a real rush up last week and then got whacked today, and the other one is AMX, which is a really interesting stock as well, gold stock. So let's have a look first of all at PLA, and you can see we had the start of a move which occurred Monday of last week. We got some pretty good volume. As you can see, this time the volume did follow through to the upside, but I don't think it really got on most people's radars until maybe the Wednesday, when it was somewhere between 9 and 11 cents, and it was getting pumped up by one of the newsletters, and ultimately I think a lot of people would have been drawn into this trade above the 12 to 15 mark, and you know, promptly it did a big turnaround today. Now, I didn't trade this stock, but certainly one of my team did, and he traded it very well, getting in, I think, around about 9 and getting out around 14 or 15, which was some pretty smart trading. So again, just be really careful about jumping on these stocks that are being hyped by newsletters, because you're never quite sure what's going on in the background. Let's have a look at AMX. And AMX is a stock. Let's have a look at it on the weekly. Gold stock in West Africa. It's still a developer. It's probably 3 years away from actually making any money. But they have developed or identified quite a big resource. But you can see the price has come off a long way from $3.30 down to about $1. Is it in a position to be turning around? I don't really know. All I can say at the moment is that the trend is firmly down, but it is oversold quite substantially. Now, this used to be a market darling because it ran from around 30 cents to $3, so it rose tenfold. and I think a lot of people have held on to that market darling status for far too long. If you're in a stock and it's been a market darling and it starts going down, and I guess this week here, which was the 7th of January of last year, when you get a really big candle like that, a very definitive down week with a big range closing on its lows, just get the hell out of there. If it goes up without you, if you've already made quite a bit of money, that's great. But you know, a big week like that really does often mark a big turnaround. So it's best to get out of the way. You can always get back in again. So that's all I've got to cover. I've got a couple of questions, but I've also got quite a few here as well. So I'll deal with those first. So the first question is, what will the copper price be likely to do over the next 3 to 9 months? My goodness. In general terms, I mean, I'm fundamentally a bullish on China. That's my fundamental bias, and I need to make sure that I don't let that colour my thinking too much. But I have studied and researched China extensively for the last 5 years, and yes, they'll have their ups and downs, and there'll be plenty of volatility. But I'm convinced that China's demand for raw materials will continue in an upward direction for the next 10 or possibly 20 years. Even if their growth rates come down, you know, we're talking about China now growing at 7.5% this year rather than 10% 2 or 3 years ago. But the thing is, it's 7.5% of a much bigger economy than it was 3 years ago. So the amount of iron ore and the amount of coal, the amount of copper that these guys are going to be sucking in, oil, is getting bigger. And I think the people that are saying, you know, if China's only going to grow at 7.5%, we're in a lot of trouble, I just think they're missing the point. It's 7.5% of a much bigger pie. So my view will be that, and I've been saying for a year now that on what I've studied and read, that the copper market would be in supply deficit for 2 years, at least 2 years. Now that was a year ago. So my expectation is that copper should remain strong for, you know, at least another year. Now, does that mean it can't dip down? Of course not. But I think if there are any dips in the copper price, it's likely to be more to do with the futures market and a bit of mucking around in the futures market than it is in the real supply and demand market. So I would expect copper prices to do reasonably well over the next period. Okay, how do I trade bonds? I'm not the person to be asking that question of. I've never traded bonds. I guess if you've got a CFD, if you've got some sort of CFD platform, then they will quote bonds, and what they'll be quoting is the actual bond price. So when bond yields go up, in other words, when interest rates go up, then bond prices are going down. So what you'd be looking to do would be to short sell the actual bond price. But look, to my way of thinking, that's a market for professionals. I don't trade it, so I don't know enough about it to have an opinion, other than I would be incredibly cautious about how you did it, because clearly you are taking the other side of the trade from the US Federal Reserve. The US Federal Reserve wants to keep bond prices high and yields low, and those guys have got pockets that are far bigger than we've got. So just remember who you're actually doing battle against. It's the US Fed, so yeah, be careful on that one. Now, the question here, how do we get upward movement on our share market when the dollar is so high? It's not a bad question. Well, I guess you've got to look at what's been holding our market back. And I believe there are a number of factors, one of which is the high Australian dollar. Let me back up one. Our index is really determined by the value of the top 10 or 20 stocks at the most. All the rest doesn't matter. And the direction of our top 10 or 20 stocks is not really determined that much by Australian buying. I believe it's controlled a lot by overseas buying because our market is just so small and the amount of overseas money is so large. Now, if you're an overseas investor looking at the Australian market and we've got a high dollar, then our stocks are more expensive than they would have been, some time ago. So the high Australian dollar has not been helpful in terms of encouraging overseas investors to buy Aussie stocks. But also what's not been helpful is the continual changes in the political landscape, the carbon tax, the changes to the mining tax laws. I think there's a great deal of uncertainty about what's going to come out next, and that's not just having a swipe at the Labor Party. I think both sides of politics, and including the Greens, I just think have created an extraordinary level of uncertainty for overseas investors. So I think that's a big influence as well. So how do we get upward movement? I guess at the index level, I'm not expecting a great deal of upward movement, and that's why I've been focusing on the section of the market where the real activity's been, and that's been in the small caps. So yeah, I guess I'm not expecting too much in the way of upward movement, but I'd have to say that when you can buy stocks like BHP for 9 times earnings, if China doesn't have a hard landing, then you've got to say BHP is pretty undervalued. And if BHP and Rio took a decent step to the upside, then you'd see 200 or 300 or 400 points on our index pretty quickly. Now, Newmont is not listed on the ASX. No, it's not. I was merely showing that from the point of view of trends in global gold stocks. It's an American company. Do I think buying AZM today was a bit early? So that's a zoomer looking at AZM. Now again, I've got to be very careful what I say here because I can't really comment on specific stocks, but let me just give you some visual facts about what I'm seeing. Clearly there is a very significant downtrend and a fairly nasty downtrend. Yeah, I don't like the look of that at all. And I'll show you some other charts in a minute that have got a similar kind of, this has been going down now week after week after week since December. In a kind of in a normal kind of trend, you can see that there are sorry about that. In the normal kind of trend, you can see every 4 or 5 or 6 weeks you get a bit of a blip. And we haven't had one of those blips now for 13 or 14 weeks. So that really bothers me. Let's have a look on the daily chart. Pretty big down day today on big volume. So I've got to say, that looks a bit nasty. It does look a bit nasty. So I haven't been following this stock, so I don't know what might have precipitated that. But let's just have a look at a couple of other stocks that have got a similar kind of pattern. This is Mirabella Nickel. Let's have a look at this on a weekly chart. And you can see this is a stock that used to trade up at $7.50 in May of 2008. Now this was a really hyped stock. It had gone from virtually nothing to $7.50 in a pretty quick period of time. It went from $1 in 2006 to nearly $7 in 2007. So this was a market darling. This was a huge greenfields nickel deposit in South America. But just look at it since January of last year, so nearly 15 months. And look at the last period since December. It's really got a head of steam to the downside. In fact, it's really the downtrend is accelerating. See what I mean about these really big, definite down candles? It's not a good sign. So yeah, I can't answer your question. Do I think it was buying a bit early for reasons that I said before? But yeah, that candle today and the volume is not really what you want to see, in my view. Now, a couple of other questions that came in earlier by email. There was a question about what sort of charting software should I buy if I'm new to the market. My very firm view is that I really like to see new traders learn how to trade first, learn how to get a trading plan together, learn how to get something consistent happening in terms of entries and exits and decision making. And I really encourage new traders not to worry about software too much at the start, because for two reasons. One, you don't want to spend time learning how to drive the software, and learning how to use software and interpret charts is something that really does take a long period of time. You've just got to look at literally tens of thousands of charts over a period of time and see how that chart pattern pans out. So really having software, unless you know how to interpret it, doesn't really help you too much. I think you're much better served focusing on learning to trade consistently and having someone that can point you in the right direction of high probability trades. So I'm a bit lukewarm on starting with charting software. Now the other question that I had was, if I'm new to trading, how much time should I set aside to learn? Gosh, it depends on what you want to achieve. If you just want to be an effective trader, and you can tap into a good information source with a good plan, you don't have to spend very much time at all. Maybe, I don't know, half an hour a day. But if you actually want to become over time an independent trader, so that you need to work with somebody or some organization that can keep you on track for a while, then you probably should be thinking more like maybe an hour a day as you can, so that you can start to try and follow along and interpret as well. But look, I think it's a hard question to answer, that one. Now, what sort of returns can I make? That's an equally difficult question to answer. There's a whole range of answers here from that depend a lot on how much time you've got, what sort of risk profile you've got, what kind of objectives you think are worthwhile. If you're leaving your money in the hands of somebody else and they're generating you some single-digit return on your money during the good years, and maybe losing your money in the bad years, then I guess any kind of return above 10% is probably a good return. From a trading perspective, I've seen traders produce returns anywhere from 20, 30% a year to hundreds of percent a year, although the latter returns, I'm not sure how sustainable they are over the long term. But for me, I think it's really about getting consistency, and if you could get somewhere between 20 and 50%, then I think you'd probably be pretty happy with that if you could churn that out consistently year after year. Now, in saying that, I'm not giving any indication that those are the sort of returns that anybody could get, because clearly they're not. You need plenty of discipline and you need plenty of help to be able to generate those sort of returns on a consistent basis. But yeah, hopefully that gives you a little bit of a feel for it. Now, possibly the last question I've got here is, do I think gold's been moving higher the last few years? Do I think gold is all hype and the miners don't have any upside really? Don't people buy with safety in numbers? Okay. All right, well, look, my view on it's possible. Let's just have a look at the gold chart. What you've said there is possible, that gold is all hype, and let's just look at it on a weekly chart. It's probably more relevant. It is possible, however, I would assign an incredibly low possibility to that happening. Gold started moving in 2001, and it's gone up every year for 11 years. So, as they say in the trade, the trend is your friend. All the circumstances are in place for me that gold will continue to go higher, and that's due to the supply and demand situation for gold. It's due to the currency debasement that's going on. It's due to the fact that central banks, outside of central banks that are basically big holders of US treasuries and US dollars, are now switching gears and are desperately trying to buy gold. China is a huge buyer of gold. China, a couple of years ago, started a huge retail marketing push for people to start to own gold. You know, mine production is struggling to increase. Demand is increasing rapidly. The exchange-traded fund market continues to increase rapidly. Whichever way I look at it, I just cannot see a situation where gold goes significantly lower than where it is. Now, the gold market is subject to short-term manipulation. Is a dip to 14 or 1500 possible? Yes. But again, I would still come back and say over the next 1, 2, 3 years, I would expect gold to continue to work its way higher because the fundamentals, to my mind, are that strong. And I believe at some point we will see gold producers in particular, and then towards the end of the cycle we'll see the gold explorers really take off. But I think you're going to see some really solid things from gold producers probably over the next 3 months. That's my personal view. May not pan out that way, but I think that's what we're going to see, because gold producers in this country anyway are cheap and they're seriously good businesses. So I think as long as you focus on those, I don't think you can go too far wrong, because you're not really buying speculation. You're not buying something that you know, that's a real speculative punt. So I believe if you focus on the best gold producers in Australia, I think you'll do pretty well over the next year. All right, well, that appears to be all the questions for now. Hopefully that's been a good session for you. As I indicated, any feedback that you can give me about what it is you want to see in these sessions, I would love to receive. If you want to send me an email, either to it's probably best just to send it to support@specialistshareeducation.com.au, then I'd be very happy to accommodate whatever I can. So that's it for this week. Now, next Monday, of course, is Easter Monday, so there'll be no webinar next Monday. It'll resume in 2 weeks' time. So that's it for now, and we'll see you soon. Cheers.